where we are historically, right? We've been in a period of generally falling rates since about 1982, right? I mean, Volcker kind of really started to put the brakes on things a little bit after Reagan took over, and since then we've been in an environment where rates have been falling. We've had blips, but certainly it's been an era of falling rates for the last 40 years. So right off the get-go, you have, in 1980, dating myself, I was 15 years old. A lot of people that are running the markets weren't even born. So this notion of inflation is, yeah, there we go. The notion of inflation is something that I think very few people have much of a grasp on. It's a foreign concept. So the Fed certainly has an unenviable task in terms of trying to thread all these needles and meet all the demands of their various masters. And like you said, certainly you would love to see the adults in the room step up with some rational fiscal policy, but I think that the odds of that happening are virtually nil, right? You probably can't even pass a babies are cute law at this point in time with where we are politically. So it'll be an interesting period of time going forward in terms of how the government deals with what's obviously a set of interest rates that are historically off the mark, with pressures that are going to move them up, whether the Fed does it explicitly or not. We're going to see, as going back to the gringo theme, as a big gringo, I was looking at an article today. The price of chicken wings coming up to the Super Bowl are up about 50%. Now, chicken wings are just one piece of the economy. Obviously, it'll be big in a couple weeks, but nonetheless, there's a lot of factors at work that are going to be pushing interest rates if this doesn't indeed turn out to be a transitory rise in prices in the short run. But you've seen Heinz, you've seen food companies, they've been raising their prices. They've announced ongoing price increases. So one of the things that I think sets up our firm in terms of what we do is we spend a lot of time measuring corporate performance and then trying to figure out what companies are worth. And Adam and I have had a number of discussions on Twitter, about the pros and cons of doing valuation. We'll get into it deeper. But one of the things that we spend a lot of time with is trying to move from nominal or what we call ad hoc rates of return. When you have a company whose income statement is in current dollars and the balance sheet is in historic dollars, what exactly do you have when you calculate an ROI? For a number of years, we were sort of like the Maytag repairman. Nobody cared about that message because we'd say it's important to have real rates of return so you can measure companies through time, so you can evaluate what management's doing. In a low inflation world, that's not as important, although when you have companies whose assets are 30 years old, all that compounding does make a big difference. If you looked at a company like Exxon, almost half its balance sheet, if you inflation adjust it, moves up to $100. So our firm is specialized in that, trying to figure out what exactly is the economic profitability of the firm. Then how do we take economic profits and link it up to estimating a firm's intrinsic value?
And do you think about the sort of turn on inventory or turn on the assets or whatever the underlying business is in the context of the inflationary regime? Does that enter the zeitgeist for you guys, or is that more of a non
right
thing?
So for absolutely at a company specific level, we're focused on turns, the efficiency and how much capital is required incrementally to support the business and how much replacement CapEx is required to keep the existing cash flow whole. In terms of at a macro level, the asset turns, that we really our swimming lane really is understanding individual companies. We'll aggregate some data and we can talk about some of the insights that we have to share at kind of a macro level. And we're starting to do some work on duration and trying to get our arms around that whole concept of equity duration. I think we have some interesting things to share in that regard. But all of our work tends to focus really on individual companies. Are they creating or destroying value? In other words, we want to evaluate management. Are they wealth creators? Are they good stewards? Are they turnarounds, or are they wealth destroyers? That's kind of the corporate performance piece. And then we move on to what is the firm worth, and is it trading above or below its intrinsic value?